You pack up your desk, hand in your badge, and walk out of the lobby for the last time. But while your employment is officially over, the capital you've built inside your company's retirement plan is still sitting there. Almost immediately, you'll hear the same piece of financial advice from former colleagues and financial media. Take your money out and roll it over into an individual retirement account, or IRA, to get total control over your investments. Brokerages push this narrative heavily. Moving your 401k balance into their ecosystem increases their assets under management. That is the exact metric they use to generate their own revenue through account and investment fees. Executing that transfer is a permanent one-way transaction. The moment that money leaves your former employer's plan, it loses a highly specific set of legal and financial characteristics. You are trading a heavily fortified institutional vehicle, like a corporate 401k, a 403b, or a 457 plan, for a purely retail account. This decision tree shows what happens when you separate from your employer. Before you make a move, you have to evaluate 5 specific scenarios where an automatic IRA rollover can actually destroy your wealth. Gaining total control over your investment choices often means surrendering powerful institutional shields that you can never get back. Let's follow the first branch of our decision tree, the hidden costs of retail investing. Company 401k plans have access to what are called institutional pricing rates. Think of this as a bulk corporate discount on the underlying fees of mutual funds and index funds. This diagram compares the collective capital of thousands of workers pooled together against a single retail IRA. Because the corporate plan is buying in massive bulk, they have the leverage to force expense ratios down to fractions of a percent. The sheer size of that pooled capital actively drives down the percentage of fees charged to the participants. Once you leave that pool, you are largely stuck paying higher retail rates on the exact same funds. Leaving the corporate plan also cuts off your access to a highly specialized asset called a stable value fund. These funds operate much like low-risk money market funds, protecting your principal balance from market volatility. However, they consistently offer higher interest rates, and they are exclusively available to the corporate 401k market. Leaving your old plan to gain a few extra ETF options often means volunteering to pay retail prices for wholesale investments, creating a permanent drag on your long-term yields. The next branch applies if you hold highly appreciated company stock directly inside your 401k. If you roll that stock into an IRA, every dollar of eventual withdrawal, including all the gains that stock made over the decades, will be taxed at your ordinary income tax rate. This flow illustrates a workaround known as net unrealized appreciation, or NUA. Instead of moving the company stock into an IRA, you transfer it directly into a standard taxable brokerage account. There is an immediate trade-off here. You have to pay ordinary income tax at the time of the transfer, but you only pay that tax on the stock's original purchase price, its cost basis, not its current market value. By absorbing that initial tax hit on the cost basis, all of the subsequent growth is shielded. When you eventually sell those shares, the profits are taxed at the long-term capital gains rate, which is significantly lower than your ordinary income rate. Compare that timeline to an IRA. The IRS dictates that once you hit age 73, you must begin taking required minimum distributions, or RMDs. These are mandatory annual withdrawals, meaning you are forced to sell the stock and pay ordinary income tax, whether you want to or not. Be careful if you hold depreciated company stock. Inside a 401k, the wash sale rule, which normally prevents you from claiming a tax deduction on a security you sell and quickly repurchase, does not apply. You can sell and repurchase to reset your cost basis, maximizing the NUA strategy later. For corporate veterans with heavy employer stock positions, blindly moving funds into an IRA can trigger a massive, entirely avoidable tax burden. Our third scenario evaluates professionals who carry high personal liability, like doctors, independent contractors, or business owners. Corporate retirement plans are governed by the Employee Retirement Income Security Act, known as ERISA. This federal law provides near absolute immunity from general creditor judgments and civil lawsuits. The only entities that can consistently pierce an ERISA shield are the federal government collecting IRS tax liens or a court enforcing specific child and spousal support orders. An IRA is not an employer-sponsored plan. The moment you roll your 401k into an IRA, your ERISA protection evaporates. Congress passed the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. This legislation caps federal bankruptcy protection for traditional and Roth IRAs at exactly $1 million. Beyond bankruptcy, standard lawsuit protection for an IRA is dangerously reliant on state law. Depending on where you live, an IRA might be completely shielded, or it might be entirely exposed to creditors. Executing a rollover strips away a bulletproof federal shield and replaces it with vulnerable, highly localized legal defenses. The final branch addresses early retirees, or those pursuing financial independence. The baseline rule for an IRA is rigid. Your capital is locked behind a 10% early withdrawal penalty until you reach the age of 59 and a half. This timeline illustrates a major 401k liquidity advantage. If you separate from your employer during or after the year you turn 55, you can start taking penalty-free withdrawals from that specific 401k. The absolute condition here is location. The capital must remain inside that specific former employer's 401k infrastructure to qualify for this early access. If you do roll the money into an IRA, your only escape hatch for early withdrawals is committing to the substantially equal periodic payment program authorized under IRS Rule 72T. SEP requires you to lock into a strict IRS-formulated withdrawal schedule based on your life expectancy. You must take these exact payments for a minimum of 5 years or until you hit 59 and a half, whichever is later. Any deviation triggers the 10% penalty retroactively. An impulsive IRA rollover can trap cash you need right now behind a 5-year penalty wall, disrupting carefully planned retirement timelines. This chart maps out exactly who should execute a rollover and who should leave their funds where they are. If you are a standard investor with a high desire for investment control, seeking low-fee index funds, and you carry no specialized tax burdens or legal liabilities, you sit in the lower right quadrant. An IRA rollover makes sense for you. However, if you are retiring at 55, hold highly appreciated company stock, or work in a high-liability profession, you belong in the upper right quadrant. You need the institutional protection of your 401k. There is one final variable to check: your former employer's specific administrative rules. Companies often enforce minimum balance requirements to keep your account open. They may also strip away your fund allocation privileges, or start charging you new specialized administrative fees once you drop off the active payroll. If you are forced out of your old plan but still want institutional benefits, you have an alternative. You can execute a rollover directly into your new employer's 401k. This is particularly useful for older employees who want to keep that capital shielded, as you don't have to take required minimum distributions from the plan of the company where you currently work. Taking control of your retirement capital is important. Just make sure the heavily marketed promise of investment freedom doesn't blind you to the permanent loss of your institutional armor.